What's up guys, Ryan here back with another video, and in this video we're going to be talking about the power of 3, okay? And what I mean by the power of 3 in this video is the power of having 3 confluences before entering a position, right? So over my 4 to 5 years of trading ICT, I've had plans that have a plethora of different confluences. I've tried plans that have 1 or 2. Okay, but I found that having 3 confluences in the marketplace before entering a position is the sweet spot for having a really, really good edge. Okay, so having too many confluences, right, sometimes can be hard to follow, right? Can kind of get confusing, right? And then having too little of confluences or having 1 or 2, okay, is not enough, right? So 3 is the sweet spot, okay, for having a defined, profitable edge in the marketplace. You don't need anything more or anything less, right? So the 3 confluences that I use, okay, are predominantly the order block, the fair value gap, and the balanced price range, okay, either or, and the Williams percent R, right? So these are the 3 things that I look for in price action to get me the best entries and the lowest resistance liquidity runs within a market maker model. Okay, so we're going to be looking at these 2 examples here on the sell side of the curve to kind of give you guys some context and a chart to what I'm explaining here. So this is NASDAQ here, or US 100 on the 5-second chart. Okay, this price action just unfolded. It is currently 11:13 in the morning, and this fractal here was at the end of the macro at 10:10. All right, so in this first example here that we're going to be looking at, so the first thing, right, we have an order block right here mapped out. So this is the last up close candles, 2 or 3 up close candles before the down move, right? So when price returns back up to that order block, okay, this can be utilized or used as one of the PD arrays or confluences that we look for in price to engage. The second thing is the fair value gap or balanced price range. Notice how in this range here, there is no defined fair value gap. Okay, so what do? We look at the buy side of the complete model, right? So obviously here we're on the sell side of the curve. We took out liquidity, broke market structure, okay, and traded through this fair value gap here. So when price trades back up into this area, okay, this balanced price range, we can see that the mean threshold or the consequent encroachment of the balanced price range is getting utilized here, right? So it's overlapping with this order block, right? That's exactly what you guys want to see. You guys want to see a specific price level have 2 PD arrays. Okay, that's all you guys need is 2 PD arrays, specifically the order block and a fair value gap. Okay, that's all you guys need, right? And it's not to say that this power of 3, what I'm talking about, having 3 confluences, is set in stone, right? If you guys like trading the breaker, you can change out and plug in however you guys like. If you guys like the breaker, you guys can plug it in here at number 1. But for me personally, and through my experience, the order block is what I like to use, right? So we have this beautiful balanced price range, right? This order block here. There's also another balanced price range right in here, okay, to boot. And then we have the Williams percent R, right? So the Williams percent R really helps us with timing and pricing elements. And so this high here, we can clearly see represents the order block high, okay, that we want to utilize. So when price trades up into quote unquote fair value and the order block, okay, at the same time, the Williams percent R is taking out this respective high. Okay, so what does this indicate to us? The indicator is taking out the respective high, but in the price chart, we're failing to do so. Okay, this is the characteristic, this is the tool that I use to capture highs and lows of price swings. And it's just a very, very beautiful tool to use and to help us kind of find the best PD arrays within the market maker model. Okay, so this tool here, guys, you guys are really going to want to study. It's really going to help you with trade selection, PD array selection, and which range really is smart money going to be loading their orders at. Right, so this first example here, very, very beautiful, having all three confluences, right? And we can see here, price sells off very, very beautifully. The second setup, the exact same thing, right? It's the exact same framework, having the order block, fair value gap, and the Williams percent R. So these two up close candles are the bearish order block, right? This fair value gap in here, okay, is overlapping with the order block, right? So that's exactly what we need, guys. We need PD arrays lining up at the same price or within the same area, okay? And last but not least, we have the Williams percent R. Again, so this high here is represented by the order block high here in the price chart, right? So when the Williams percent R comes up and takes out this high, okay, at the same time, price is contracting and trading into the fair value gap in the order block, I know that this range here, from range high to range low, is going to be utilized for smart money to go short. Okay, so these are two very, very beautiful examples of having three confluences, and you guys can see how they both play out. Right, and so there's just one more thing that I want to touch on before I close this video, is high resistance liquidity runs and low resistance liquidity runs. So another way that I like to look at those two concepts is contraction to expansion. Contraction to expansion. And so when we're trading the internal range model, we really want to see price contract. Okay, so in both of these examples, we can see here price contracting. And what do I mean by that? In simple terms, the candles are getting smaller. Okay, the candles are grouping here and getting smaller, right? So when I see this is what I really like to see before entering a position. Okay, this is one of the signatures that you guys are really going to have to pay attention to when trading the internal range model. You guys want to see price stall here, right? Because this indicates to us that we're in a consolidation. Okay, so when price pumps up here, where are we trading into? Okay, we're trading back into the range, from this range high to this range low, trading right back into our two PD arrays that we are looking to get utilized, right? So this order block here and the balanced price range on the buy side of the curve. Price comes up once, hits the order block, hits consequent encroachment of this balanced price range beautifully. Okay, comes back up, reclaims that area, and then we sell off. Okay, what do we see right after selling off? We see expansion. Okay, and in expansions, we really want to see fair value gaps start to form. As ICT always says, you want to see the elephant jump in the pool, right? So when you start to see fair value gaps form like this in big candles start to form or start to paint, this means that you are most likely going to be on the right side, okay? So again, guys, very, very important. Contraction to expansion. Contraction to expansion. Right, one of the other things that you guys want to note is when you guys are seeing price contract, notice how there's no really fair value gaps in here for us to utilize to go long. Right, there's a small little one in here. Okay, but for the most part, price is just contracting. There's no fair value gaps forming to go higher, right? So in the contraction phase, in the accumulation manipulation or accumulation retracement, right, you typically don't want to see too many fair value gaps form. You want to see price being slow, lethargic up into that area where we want to be selling. And that gives us confirmation that price is contracting and before the expansion, right? So very, very beautiful setups here. Lots to learn from this video, lots to take away. And until next time, guys, good luck and good trading.